Parets here, founder of AllStarCharts.com, and I am joined once again on Pardon the Price Action by Steve Strazza. Mr. Strazza, let's get right into it. Some of the leadership groups have come under pressure over the past week. Is this something to be concerned about, or are these just some well-deserved consolidations?
You know, we always say one day doesn't make a trend. I would argue 1 week really doesn't make a trend either. These are very strong primary uptrends, whether we're talking about semiconductors, home builders. We could go and look at areas within industrials like truckers, railroads, other areas within discretionary, like the automakers, auto parts dealers. So there are pockets of strength, definitely. When you look at semiconductors, sure, if you see momentum divergence like that, the relative trend down a bit, something to watch, but I don't think you want to throw in the towel on these types of leaders just yet.
Yeah, I mean, listen, in these cases, we're talking about home builders, we're talking about railroads, truckers, semiconductors. These are leadership groups that tend to do well in strong market environments. These are all-time highs we're talking about in all of these cases across the board. Names like Ford, making decade-long highs, General Motors acting strong. Just these don't strike me as the types of names that should be doing well if the entire world's going to fall apart. And sure, over the last week or so, you did see them come under a little bit of pressure. But what, we're 1 week removed from new all-time highs, or in some of these cases, 1 day removed. So I don't see a couple of day weakness in overwhelmingly strong areas like homies and railroads and truckers. I can't imagine that is bearish for the overall market. I think these are some well-deserved digestions after these things had rippers like NVR and Lennar and Toll Brothers, CSX. These things crushed it. I think some well-deserved consolidation. What's wrong with that?
They're all cyclical groups. You're not wrong. Those are risk-on stocks. So
no doubt about it. Berkshire Hathaway, new all-time highs. Doesn't sound bearish to me.
I think you want to watch the leaders, right? 5 stocks really have carried most of the weight for the major averages this year. Microsoft, Apple, Google, Tesla, and NVIDIA. We put together a little equal weight index of them. And, it just looks like a little consolidation. You don't want to see that break down and make new lows. But I don't think you are, especially after today. That chart's going to be moving higher.
All right, let's roll.
So defensive sectors. Defensive stocks have done well on absolute terms recently. Are we ever going to see the strength show up in the relative trends?
Listen, on a relative basis, they haven't done great for a long, long time. One of the misconceptions I think about consumer staples doing well, because consumer staples currently are breaking out to new all-time highs. Consumer staples and utilities, for that matter, are stocks. And if you go back throughout history, staples and utilities doing well is consistent with a market environment that stocks are going up, because they're stocks after all. It's really on a relative basis. If you really start to see some serious outperformance out of these staples, then I can tell you there's probably something bigger. There's a bigger problem going on. We've seen consumer staples outperforming for a week. Like we came off like new multi-decade lows to multi-month highs. I think that could be part of normal rotation. I don't think it's the end of the world that we're seeing some strength out of consumer staples. They were due. Look at some of these names like Costco and Twinkies and stuff like that. There's some names that are doing well in that environment. So what? They're stocks.
Church and Dwight, General Mills, Procter. Yeah, there's a lot of strength in those groups right now. You do want to see the more cyclical, more risk-on groups kind of maintain leadership and take the baton back in terms of relative strength. But let's see it.
Yeah, listen, we got to see it. And again, I think you could see temporary relative strength out of staples. We've seen it before, and then they knock them down again, and stocks go on, S&Ps and other indexes go on to make new all-time highs. So I think there's a very good likelihood that this is another one of those, and they're just going up because stocks in general are going up. All right, international stocks are next. We've seen international breadth been weak all year long for the most part. But in the last week, we saw some of the stronger groups falter as well. Things like Taiwan, for example, right? What do you think about that?
Taiwan, Switzerland couldn't break out to new highs. India had a huge gap down this week. That's an interesting chart of India. I mean, what a great indicator that's been for U.S. stocks, right? You don't want to see that diverge for too long. So it's something to keep an eye on. But at the end of the day, international stocks have been weak. They just got a lot weaker. Maybe this was like the final flush. Maybe this was a selling climax for international stocks. That's kind of where I'm leaning right now.
Yeah, I think, honestly, I think you need to look at the worst ones. Things like Chinese internet and stuff like that. These things have gotten clobbered. And I think if you start to see the worst names in the world unable to go down, I think it's what you just said, that final washout, that last just get me out. They look like biotechs. They look like the ARC names. They look like a lot of the leadership groups of last year. So if you start to see those no longer going down, they don't have to be leaders. They don't have to be ripping. They just got to not go down anymore. And I think that's a good sign for the overall market, Chinese internet. So if you're looking at international breadth, look at the bottom of the barrel and see what they're doing.
Brazil, Latin America, Mexico, Singapore. There's a lot.
Yeah, 100%.
Pennants in the Forex market. There are some tight continuation patterns in Forex these days. What do you make of the dollar index here?
It's really interesting. We're seeing commercial hedgers with very obnoxiously bearish positions in the US dollar index, some historic short positions in the dollar index. And at the same time, things like Australian dollar, you have historic net long positions. And then when you look at the euro down near key levels, I think if euro's doing well, Aussie's doing well, and these commercial hedgers are right, I think the dollar can get hit here. I really, really do. I think that the commercial hedgers are set up for that. The speculators are on the other side. I'll take that unwind any day of the week. And if the dollar starts to sell off and euro and Aussie are ripping, what does the stock market look like in that environment? What does the interest rate market look like in that environment? In my opinion, both of those are ripping, along with euro, along with Aussie. Dollars getting hit, along with those other defensive assets like bonds and Japanese yen and gold just struggling all year. I think this is another hit for the defensive assets if the dollar, because the dollar's been the only defensive asset that's done well this year, right? You notice?
Yeah, and you're seeing it a little bit today. The dollar started to go. It started to resolve higher from that pennant. And then after the Fed meeting, it reversed hard. And if you look at something like the euro, that had a nice day. AUD had a nice day. Australian dollar, Canadian dollar had a nice day. So we'll have to see what tomorrow brings. But it looks like, that bull pennant in Dixie could be failing. And in that environment, we would likely see the euro fail and resolve higher also. So
commodities are probably doing well in that environment. Oil, copper probably doing well in that environment. Look at emerging markets, probably not doing too bad in an environment that the dollar is weakening as well. All right, let's talk about the importance of the 2018 highs, right? Critical level, first quarter 2018, particularly January, risk all over the globe peaked. You see it chart by chart by chart. What are these levels telling us today? What's on your radar?
No, speaking of international stocks, it's hard to talk about international stocks without talking about the 2018 highs. A lot of these international indexes have been hanging out and are just consolidating in these continuation patterns right above those key levels. You don't want to see what were very nice multi-year base breakouts that resolved higher at the end of last year into early this year. You don't want to see those break back down and fall back in that box, back in that range, right? So if you look at something like emerging markets, it's already below those 2018 highs. You don't want to lose the all country world index. You don't want to lose emerging markets ex China. You want to see areas that are still below the 2018 highs break above them. Frontier markets is a good example. We have the overlay chart of small cap financials and crude oil. They look exactly like one another. So we're also seeing these 2018 highs come up as an area where prices are struggling for US stocks and commodities. So this is really some key levels, and there's a load of information in how prices react at these levels.
There was a lot of things that peaked at the end of 2017, early 2018, crypto included, by the way. These regional banks, if they're above their 2018 highs, it's hard to be bearish. And I think you said it, emerging markets, EEM, has already lost those former highs. But this is emerging markets with China. If you look at emerging markets ex-China, still above those 2018 highs. You don't need this chart to tell you the relative strength has been in anything outside of China. But it is a nice refresher to show us that, yes, in fact, the relative strength is in emerging markets outside of China. And if, not just EM, but, regional banks too, you really said it, crude oil struggling, failed at those 2018 highs, regional banks, small cap financials right at that level. They better come in and buy them. And I think they are. And I think they're going to send them all higher. What does that say for rates? Probably higher, right?
Rates would be moving higher in an environment where all those charts are resolving higher.
Yeah, I think so.
So first thought.
Let's go.
This is a game that we like to play where we say the first word that comes to mind. You're going to love today's word, the Fed.
One thing I learned, I think it's important to be aware when big announcements are going to come out. But the truth is, you really want to avoid what the Fed has to say. I think all you're doing is confusing yourself. I think it's a losing battle. Ignore it completely. And then the people who think they understand what the Fed is saying, you would want to ignore those even more. So rule number 1, ignore the Fed. Rule number 2, don't forget rule number 1.
So I'll be one of those people. And, this is one of the most hotly anticipated Fed announcements probably since.
Aren't they all? They freaking say that every time. I've been hearing that my entire career. Oh, the most important one. It's a bunch of horse shit.
They need something to talk about. So let
Seriously.
me say, we saw some fireworks. We came in red on the day. Sellers have been dominating the intraday session for the past few weeks, I would say, for the most part. You saw a strong reversal after the announcement came out. Powell came on and spoke. He did a press conference for about a half hour, an hour, and everything just ripped higher. A lot of nice hammers, green across the screen. I will say, and we're about to talk about it a little bit more, banks, the big banks, still a little bit lackluster. So that is still like the big holdout in this whole, snapback rally that we've experienced since last week.
All right, let's go. Final, what are we doing? We're doing a 2-minute drill. All right, an inflection point for banks. Banks have barely participated in recent weeks and remain trapped beneath their first half highs. Is this important industry group finally ready to resolve higher?
So, I like the Big Six Bank Index. When we look at the 6 largest banks in the United States, looks like they're struggling, potentially printing a failed breakout right at their pre-financial crisis highs. Everybody knows how important this level is. When you look at something like JP Morgan, new relative lows versus the S&P, European financials are threatening to break down versus the All Country World Index. KBE, which is big bank index, threatening to break down versus the S&P, or I'm sorry, XLF is. KBE is not far off itself. That's the banking ETF. So I think you really want to watch these groups. This is an all-important group. We had a big save from interest rates last week, the 10-year, the 30-year, back above our risk levels. You would expect in that environment that banks are catching a bid and doing well. I think that's the best confirmation you could see for that rebound in interest rates and interest rates reclaiming that level. I think you really want to see the banks start participating to confirm some of that action. And they're not yet. They're really not. And for me, that's the biggest negative right now. Bulls need to clean that up.
Listen, it's an interest rate play, I think. It's a small cap play. I think if they really come in selling bonds for the rest of the year, you're going to see that outperformance out of small caps. I think you're going to see the performance from the regional banks as well. Financials doing well. They're knocking down bonds. Rates are up. Dollar down. I think all of that, means stocks are screaming higher. Crypto's screaming higher. I got to believe regional banks are doing well in that environment. I think you want to be buying relative strength. We've named a bunch of them. You name some of the ones that are showing relative weakness like JP Morgan, like Citigroup. I would avoid those and stay with where the strength is. Before we talked about railroads and home builders and semiconductors, that's where the strength is. Within financials, where's the strength? It's in reinsurance. Look at Marsh McLennan. There are stocks within those groups of financials that are doing very well. And I think looking at the new low list is probably a bad idea. Looking at the new high list is probably a better one.
Fair enough.
How do you feel about that?
Listen, yes, you want to focus on the leaders, but we talk about it all the time. The banks are important. You do want to see them at least participate. And I think they will, right? If everything else is going to be moving higher, we're going to see rates reclaim this level. Commodities are going to start working again. Then banks are going to work in that environment, but we're just not seeing it yet. So,
no doubt about it. All right, final word. What are you going to leave the folks with?
So, I've been getting a lot of questions about cryptocurrency. I think it maybe had something to do with the Capitol Hill hearings last week. Someone asked me this week if I thought there was still a risk that crypto could be banned and the Bitcoin could go to zero. Bitcoin could definitely go to zero. And you never want to say never about stuff like this, but if it goes to zero, it's not going to be because of government regulation in the United States. There's too many vested interests at this point. And in fact, I would take the opposite side of that argument. Institutions like certainty. They hate uncertainty. Excuse me. For them to allocate capital the right way, they want to know what are the regulations? What are we dealing with here? They have compliance departments to deal with this stuff. So it's not going to completely blow up the space. I think they would actually like it. So I wouldn't be afraid of that. What do you got?
It's interesting. And I'm not one to watch congressional hearings. I mean, that's the last thing I would ever watch. And I watched them. So, full disclosure. I thought it was fascinating. Some of the CEOs of these crypto companies, I certainly learned something, and I'm in this stuff all day, and I learned a ton of stuff. So definitely, I encourage you to check that out. We'll put the link in the show notes. And then my final word is about market breadth. you know, it's been a topic of conversation that, I mean, we talk about it every day of our lives forever. And this year, certainly, we've been talking about the deteriorating market breadth since February. And now it seems that everybody is a market breadth expert. And everybody is telling you that because market breadth has deteriorated all year, that the stock market, the S&P 500, the Dow, the NASDAQ has to catch down, right? That is the narrative currently by people who went to Investopedia and looked up market breadth. Shout out to our friends at Investopedia, by the way. Great website. But the point is, you know, market breadth, I think people are mistaken by it. Because the average NASDAQ stock's down 37% doesn't mean that the Qs need to catch down to that. Understanding market breadth is just understanding how the market is behaving underneath the surface. What is the median stock, the average stock? What are they doing? And is it or is it not different than the overall indexes? And with that being said, which are the sectors that look terrible that are dragging down those breadth numbers? And which are the sectors and industry groups that are bucking the trend, right? We talked about emerging markets, biotechnology, the IPO index, you know, Chinese internet. These things have been getting crushed, but at the same time, you have areas that are doing very, very well. So I think market breadth is more about understanding positioning, understanding how you want to be positioned, which areas you want to be buying and which areas you want to be selling or staying away from, rather than coming up with these grandiose conclusions about what indexes should be doing because of what breadth is doing. It's two different things, and I think if you're focused on what the major indexes are going to do because of what breadth is doing, I think you're going to be very confused a lot of the time. And I think just understanding where the breadth improvement is and where the weakness is, I think is more important than are the indexes going to listen to breadth or whatever. You know what I mean? That's how I feel about that.
There's a lot of value and information in looking under the hood. When you look at it on a more granular basis, you can see really where the strength is. And just to add to your point, the way I learned breadth was basically to ignore divergences the majority of the time. And this is one of those times that you want to do that, I think.
Yeah, there's a lot more information out there than just what the indexes may or may not do because of it. Ladies and gentlemen, this is Part in the Price Action. I am JC Parets. This is Steve Strazza. Make sure to follow us on Twitter. I'm at All-Star Charts. Steve is at S Strazza. Steve, always a pleasure, buddy.
Thanks, man. Talk to you next week.
We'll do it again soon. Salute.